Me now, post 9, Eric Johnston of Cantor Fitzgerald. It's good to see you again.
Thanks for being here.
So you're as bearish as you've been? Still?
Yes. Yeah,
undeterred.
Undeterred. Yeah, there's been no change. I think if you see what's been going on the past couple of weeks, there's a thought that we could have a soft landing that's being priced into markets. There's been some short covering going on from hedge funds. CTAs have been buying, but I think if you play out the soft landing scenario, there's some downside to that scenario, right? In that scenario, the Fed is unlikely to cut rates. The 10-year yield, as a result, will probably need to rise. And that won't get rid of this concern that a recession is coming, because ultimately this market goes in cycles. The economy goes in cycles. The unemployment rate is 3.5%. We are, by definition, at the top approximately of the cycle. And so if the recession doesn't come in 23, the market's then going to think, okay, maybe it's coming on 24. So I think you're number one, that'll create a lower multiple that the market would put on numbers. And then also earnings estimates I don't think would rise in that scenario. But to be clear, we don't think we're going to have a soft landing.
Okay.
But I understand that is a possibility. And if that happens, I still don't think stock prices will go up. And I actually think they're still downside.
What happens if the economy is just far stronger than you have anticipated, and that just doesn't enable your scenario to play out, and the economy is much stronger than anybody anticipated? And you can look at any chart or historical metric that you want and say, well, when this happens, it always means a recession. When the Fed does this, this happens. But it never and can't take into account where we started this whole thing.
Sure. So I would.
That's not that outlandish, by the way.
That's not that outlandish. The one thing that I would say a couple things. Is number one, the rate market disagrees, right, with that premise. The 3-month 10-year is inverted by 118 basis points.
No question.
With the 10-year at 3.5%, the Fed going to 5%, the rate market is saying they're going to need to cut over 200 basis points in the next 2 years. That's only going to happen. That's not going to happen if the S&P is at 4,000, the unemployment rate's at 3.5%. So the rate market does think that things are going to get materially worse.
There's no question about it.
And the second thing that I would say,
it doesn't mean it happens every time.
That's true. That's true. But if you look at the past sell-offs that we've seen in the market, they've all started with a very low unemployment rate. So February of 2020, that was a 50-year low unemployment rate. 2007, that was a 6-year low unemployment rate. In the bubble of 2000, everything felt great in February of 2000. We were at a 30-year low unemployment rate. Things felt great, and then obviously we know things completely fell apart. So in the beginning of these things always, there's a sense of complacency that goes on, where maybe we can get through this, but the reality is that it always feels this way in the beginning. And like I said, we go in cycles, and I think over time, if you sold a 3.5% to 4% unemployment rate and you bought a 10% unemployment rate, you would do very well. And right now, we are towards the end of the cycle, and whether it's a cycle ending in 23 or 24, it's probably on its last legs.
Okay. What if you're right? What if everything you said makes perfect sense to everybody who's listening, but you're tactically wrong? That it just takes much longer to play out than you thought. And you miss a whole lot of upside in the market before the you-know-what allegedly hits the fan in the second half of the year, that most people said tough first half, Fed done, maybe they signal they might cut, stock market has a good second half of the year, saves the day. What happens if it's reversed?
So if I'm wrong, I think wrong will be the market going sideways. I think, and it taking longer than I think to sell off, because I think there's actually, as we look at the economy, I actually think the second half of the economy was going to be worse than the first half. And the reason why is because we still do have an unemployment rate of 3.5%. There are still excess savings. The consumer is still, at the moment, strong, although they're whittling through their savings and they're increasing their credit usage. So I think it will be pushed towards the back half of the year. However, stocks are a discounting mechanism, as we know, and so I do think the sell-off is going to come in the first half. But I think where I would be potentially wrong with that, it would take longer than I think, rather than the market going to 43, 44, 4,500 in the meantime.
But see, as a tactical person, when do you cut bait on the line and say, you know what, I think I'm wrong tactically in the near term, and I don't want to cost our clients, an opportunity? How does that all play into the way you think? Because you can be a short-term guy, right?
Sure.
That's what tactical
Absolutely.
is. You can change your mind if the facts change.
Yes.
If the facts suggest that the market is actually not going to be as bad as you once thought, for now, what do you do?
So, I think I can see from a price perspective where, due to positioning and due to sentiment and broadly, that we could get a little bit of a rally. But this is a case where we're so far against what I think, against the ceiling, that it's going to be very hard for me to paint a scenario where the market's going at 43, 4,400, and I'm saying I'm wrong, I missed something.